Hi, warriors, and you have to be one to be in this business because I don't know anyone who hasn't gotten knocked down that has still around and been able to make a living out of the market. Today, we're fortunate enough to be talking to Gary Savage. Gary granted this interview. Welcome to TradeGate Hub. Thank you, Gary.
Thanks for having me on, Dale.
All right, so we were talking a little bit before we started to roll about what experiences we go through. What were you doing before the dot-com bubble that was a drawdown situation for you?
So I've had multiple businesses. I think the one I had right before the dot-com burst was a restaurant, if I remember right. And then I got kind of interested in investing. Actually, we had already started the downside of the bubble imploding, so I got in at exactly the worst time.
Yeah.
Got beat up pretty badly, and instead of learning my lesson and doing something else, I have a very stubborn personality, and I decided I wanted to figure out why I'd lost money and how the markets worked, and over years I developed the system that works pretty good for me and that I use now.
Okay. So it's okay to be wrong, not okay to stay wrong. And like I told you off camera, I've blown out a few accounts in my career, and I don't know anyone, and I've talked to many that haven't had an experience like that. And in fact, I know a guy had a clearinghouse in Chicago, RB&H. It was big, a Refco, and he said he didn't know a trader until they went deficit, what kind of trader they would be, how they would handle the drawdown. And the guys that came back from trading, he'd let them trade with a D and trade out of it. So here we are today, Gary. Pretty interesting markets. I've looked at your Twitter stream. I watched your video Saturday, Gary. That's why I reached out to you. You're looking for a pretty good decline in the S&Ps. It really started to roll yesterday. We're getting a bounce today. Is that scenario a narrative that you're looking for, even kind of like a mini, big swoosh to the downside to maybe 4,100, 4,200's a battleground as far as I'm concerned?
So what has happened is when the banking crisis popped up in March, the Fed started, more QE. They had to bail out all of those investors and depositors in the banks, and that
well, they didn't have to.
They didn't have to, but they did. And that liquidity pushed the market up, and the problem well, they created this problem. They pushed price way too far above the long-term mean, and by that I mean the 200 average.
Oh, okay.
And so we're now in a profit-taking event. I don't think this is the end of the bull market, but bull markets have profit-taking events.
Okay.
And price gets stretched too far above these averages, you have a regression. Usually one of two things can happen. You can have a regression event, a very sharp event that pulls price back down to that moving average, or sometimes you'll just churn sideways for weeks and weeks or months and allow the moving average time to catch up.
Did yesterday give you a tell on which way we're going? I know we're not following through today, but I had it break through some pretty important areas.
Not for sure just yet. This daily cycle is very mature, so I've noted this before, that when you get really late into these daily cycles and the correction is coming very late, what happens is you compress the amount of time that you have for the correction to run its course.
Okay.
And I can probably pull up a chart here and
you
show
want
you.
to? Okay, so I was noticing, here's the before you pull up yours, the trend channel break that we had from the March lows, and then we had on the weekly this overthrow. So you and I, come to similar conclusions using different methodologies. So here's when we had the overthrow. Now we're back inside of it. as long as we close under 44.20. So we're getting a test of it right now. This to me looks like a market that's pretty vulnerable.
So we are definitely in the declining phase of the intermediate cycle. And
what would tell you, because I understand the rationale of being in a correction camp. We've had a great run. We've had a huge rally. And so after something like that, and the bears have been embarrassed, right? Most people are going to be looking to buy breaks. So what's going to tell you it's more than just a correction?
It's not. If it was more than a correction, we would have topped this intermediate cycle would have topped left translated. And by that, I mean, the average cycle length, intermediate cycle length for the stock market is about 20 to 25 weeks. So if it rallies, let's say 13 weeks or longer, then the advancing phase is longer than the declining phase. So generally what happens is, when you get the declining phase of the cycle, it just doesn't have as many weeks to progress. And so you generally don't drop below the previous intermediate cycle low. And that's what's happened here. We've rallied for, I think it was 19 weeks. So this is a
forever
cycle. Yeah. And so that generally does not happen in a bear market. That happens in bull markets. And then what I was describing is that when you get one of these that translates to translates to an extreme degree, which this has, then you compress the amount of time that's available for the declining phase to unfold. So if it's still gonna bottom in the normal timing band of 21 to 25 weeks, you don't have very many weeks for that to progress. So generally what happens when
will it, Gary? How much longer is a time window for this cycle to end?
This is why I think that maybe we're going to get some kind of a mini crash event. And that's because the smaller, so within this larger intermediate cycle, you've got some smaller daily cycles embedded within it. So here's the first daily cycle, here's the second daily cycle, and now we're in the third daily cycle. This daily cycle is very mature. It's running out of time. The daily cycles usually last 35 to 40 days. We're on, I think, day 35. So we're running out of time. So my thought is that the entire intermediate, the declining phase of this larger intermediate cycle is going to end when this daily cycle bottoms. That means that this daily cycle probably needs to just really fall apart and we get a mini crash that takes us down. I think the 50% Fibonacci, which would be about normal for a cycle like this, would take us somewhere around 4,200. But we don't have many days left to do that. So if it's going to do it during this daily cycle, it's going to have to do it as a mini crash. The problem is that you got the Jackson Hole meeting next week, and the Fed's going to throw everything in the kitchen sink at this to try and stop this decline, and if possible, get this turned back around ahead of that Jackson Hole meeting. And if they do that, we may require a fourth daily cycle before this bottom. So we could bounce, probably not make a higher high, roll over pretty quickly, and then come down and finish our intermediate cycle low somewhere out here in late September or early October. But I don't know which one it's going to be.
Okay. All right. But great call. I mean, a lot of people weren't even looking for what happened the last couple of days. So anyway, so you talk about your daily cycles, and do you go out and have weekly and monthly cycles to get an even bigger macro picture? Or does that make you, a little bit too long term, and you get caught up, maybe only having a few setups a year when you're using those?
So you're going to get a setup at daily cycle lows, and you're going to get better setups at an intermediate cycle low. The daily cycle lows, as I said, in the stock market occur about every 35 to 45 days. An intermediate cycle usually runs about 21 to 25 weeks. So you get two of those a year generally. And then you have a much larger 4-year cycle in the stock market. That's your best buying opportunity. Our last one came at the bottom of March of 2020 in the middle of the COVID lockdowns. And as everybody knows it now, that was an amazing buying opportunity.
Yeah, right.
Our next one is going to be due next year, ideally in the spring of next year, but it could stretch out to the summer or fall of next year. We'll probably have a recession. It'll look like the world is ending, and that'll be the next really great buying opportunity, like we had.
Will it be under the October lows last year?
It might.
Yeah. Okay.
If this rally that we're having now, and it's going to run out of steam here probably during the next intermediate cycle. If it can't make a higher high, then the entire 4-year cycle, let me stretch this out just a little bit. This entire 4-year cycle is potentially going to be left translated. And as I said, when you get these left translated cycles, then you can possibly make lower lows. So here's our last 4-year cycle low. Here's top so far. We haven't made a higher high yet. And this top came, let's see here, not quite. We didn't quite make it to 2 years. So in theory, right now, this is a left translated cycle. It didn't make it. It didn't rally for more than 2 years. 2 years would be half of a 4-year cycle. For it to be right translated, we would want to see it rally more than 2 years. Right now, it hasn't done that.
Yeah.
If we come down, we get our bottom here in the next either the next couple of weeks or the next if it takes 5 or 6 more weeks to get our intermediate bottom, and then we get another rally, but that rally cannot get above this peak, then we still potentially have a left translated 4-year cycle. And if that's the case, then the odds increase that we're going to drop below this 2020.
What if we don't? What if we rally to pull back to 4,200, and then all we do is rally back to 4,400? Would a close back under 4,200 turn you intermediate term bearish?
Well, I'm already intermediate term bearish because we are in the declining phase of the intermediate cycle.
Would that open up the left translation saying that the market's in trouble back under 4,200?
No, not yet. Because we might have to have a 4th daily cycle here before we complete this intermediate cycle low. So what I want to see is how the next advancing phase of the next intermediate cycle progresses. If that advancing phase of the next intermediate cycle, so let's just say, I'll take this trend line off of here, but let's just say the Fed throws $100 billion at the market here, and they stop this and get it moving back up for Jackson Hole next week. And so we end up with something that looks like, let's say this.
Yeah, Elliott guys would say that's a 4 with new highs to come.
Okay, yeah. So and then this turns out not to be our intermediate cycle low, but this is it.
Yeah.
It's a little further out. Well, then what I want to see is how this cycle progresses. If this advancing cycle makes a higher high, then the odds greatly diminish that we're going to drop below these 2020 lows. I do not think the bear market in stocks is over. I know a lot of people are convinced that it's over, but I don't think it was. I don't think, we had the potential to turn it into a bubble, and that could have been the end of the bull market. But I think the Fed started raising rates just in the nick of time and stopped the bubble phase that was potentially about to start, especially in the NASDAQ.
Yeah, like NVIDIA and all the AIs, everything really.
Yeah. So we've had a Dow theory buy signal here. I think it occurred right back here. And I told everybody at the time, I said, we've got a Dow theory buy signal. This is not a secular bear market. It's a cyclical bear market. We are not done with this bull market that started in 2009, not yet. So I think we've got a bubble phase ahead of us. Probably not going to be during this 4-year cycle. I think this 4-year cycle is probably going to be just a choppy sideways to allow some, work off this huge move right here.
Yeah,
I think we'll get our bubble phase, maybe 3 or 4 or 5 years out probably after we finish the bull market in commodities, which we've started.
Okay. All right. So let's go there. I saw a tweet. You're saying that people are going to have a second chance to buy gold. Are you looking for about 1800? You have levels in mind?
I don't know that it'll get that low. So, you know,
We're up today.
somewhere in here, we're going to get a bottom. I'm kind of thinking that gold is probably going to have to drop below this pivot right here and make at least maybe a marginal undercut of this June low.
Okay.
It's going to depend on what the dollar does. Right now, the
Yeah.
dollar is
Okay.
trying to maybe topping at that 200-day moving average. If it
I-
does, then gold may bottom today. It's too early to say, but I think a lot of it's just going to depend on the dollar. The dollar's in a bear market. I think it's in a secular bear market. I
Okay.
think we topped. We've been in a bull market for 13, 14 years. When I think it bottomed in 2008. We've been in a bull market in the dollar since 2008, but we had that sort of a parabolic move as the
Yeah.
Fed was raising rates, and that topped almost like a mini bubble. And I think the dollar is now in a secular bear market that's going to last for multiple years.
Well, the commodity currencies are certainly getting pretty cheap here, Gary. The Aussie, around 63 cents. Are there any fiats you like, or is it
I'm
mainly?
not really much of a currency trader. I don't trade currencies at all. I
Okay.
just track the cycles in the dollar, and then the euro. Basically the dollar and the euro just move inversely to each other. So that's
Right.
all I really ever look at, and I'm only concerned with that because if the dollar is in a declining phase or a bear market, and then generally commodities and gold will be in a bull market, and they're
Okay.
more likely to rally. So that's about the only thing that I
You
use.
trade miners? The gold miners?
I do trade them to some extent. I don't trade individual miners. Mining is a crappy business.
Yeah.
Miners are not long-term
It's
hold.
worse than farming.
It is. If you want a long-term hold positions, you need to buy, and I think people should be buying physical gold and silver. Those
Yeah.
are your long-term positions for metals, not mining stocks. When we get the bubble phase in the metals, which we will at some point here, gold and almost certainly silver are going to massively outperform the mining stocks. So I don't know why people have this obsession with this crappy business of miners. They can be traded, but they're not long-term holding positions.
Okay.
I would never trade individual miners. It's too much risk. The only thing I ever do is I'll buy the ETFs like the GDX or the GDXJ.
Okay.
I would never buy individual miners.
Uh, do you have a view on the CBDCs, Gary? And do you really think the banking crisis has been enough of a wall has been put up? Because I look at the XLF and I look at the regional banks, and they look like they're poised to take out their lows, their March lows. The banks still look under pressure and ugly to me, and bonds haven't bottomed yet. So their duration trade that's putting banks under is not getting better. Do you think so? Tell me if I'm crazy. I think the
So
Fed. I think the Fed knew before they embarked on this tightening regime that all the banks were loaded up with, bonds at the most expensive level since the Civil War, the lowest level since the Civil War, and that raising rates from 0 to 5 was their books were gonna take a hit. So is it possible that in order for people to accept the CBDC, they want to it's almost like engineered to cause a confidence crisis in banks, so that if the dollar is crashing like you think it will longer term, they could introduce the CBDC as a fix? And if there's enough fear throughout the population and people can't withdraw funds, they'll go for it.
I don't think the Fed is trying to crash the financial system. I do think they're trying to introduce central bank digital currencies, and that is scary. But I don't think they're trying to crash the financial system. But I
Because
think,
they're taking, oh, it's a takeover. Didn't the Treasury always print our currency? The Treasury isn't even involved in CBDC. It's a central bank takeover of what the Treasury used to do. Because anytime you would talk to a Fed official and ask them for a comment on the dollar, they would say it's not our purvey to talk about the dollar. That's up to the Treasury.
yeah, well, the Treasury prints the actual physical currency, the dollar.
Okay. Yeah.
Doesn't circulate. But the Fed can actually, like buy bonds.
Yeah.
They can print currency, but they print it on a computer. So they can buy bonds, they can fund our deficit, so the government can just spend and spend and spend because the Fed will just buy the bonds and print up the money out of on a computer basically to fund those. But
That's an ugly chart you got up there, buddy. Don't you
so it
think?
is. So I don't think this is done, and I think this is what worries the Fed most, more than anything, and why they would like to keep the market propped up is they don't want these banking indexes dropping back below these lows and making lower lows. I
Okay.
don't know that they're
I
going
don't
to.
know. Their buddies are doing okay with that going on. Four or five banks are taking advantage of buying real cheap assets as these regionals go down. It's almost like a club.
Yeah, they are definitely, the smaller regional banks are getting swallowed up by the big banks, which, of course, is going to consolidate power into a few big banks. Now the
Who's going to
government
make
all
loans to
those,
people? Yeah.
yeah.
So what worries you about CBDC, Gary?
So the thing that's worrying me the most is that basically it could it could boil down to where, like, if you don't agree with the political narrative of
Okay.
the administration that's in power at that time, they can just shut down your bank account and you can't buy food. So
Yeah.
that is very concerning to me. I think this is a very a very bad situation that.
So then I could only see people embracing it if we're in a crisis.
Yeah, well, I think they'll bill it as very convenient. You can.
Oh, you don't get disease from handling cash like during
Yeah,
COVID.
or what, or it's so easy to transact now, and then
I think it's going
sort
to
of
take more
they
than
kind of
that to
shoehorn
sell
it
it.
shoehorn it in as
Yeah.
being really convenient, and I think a lot of the population will buy it, and then all of a sudden the bad stuff pops up, and all of a sudden
Yeah.
you don't agree with the administration on climate
Yeah.
change, whatever, and then all of a sudden now you can't buy food.
Well, what if they don't like me going to the liquor store and the dispensary within the same day? Would I get a low social credit score?
Or maybe they don't want you to drive as much. You're
Yeah.
producing too much carbon dioxide. So
Yeah.
yeah,
All that stuff. So,
that's
Gary,
very extreme
I
risk.
guess in the meantime, all we could do is trade and have faith that
So I'm
maybe
going to
the
say everybody should have some physical gold and silver to protect
okay, I agree.
against this kind of stuff.
And I want to show your newsletter so that people know how to. What you could do it. You have the screen, or you could let me do it because your work is very good, Gary. I'm so glad that you granted the interview. I'm glad we met, and I learned some things from you. So I could tell by your demeanor now you're a pro.
No, thank you.
You know what else you are after talking to me and letting me interrupt you for 30 minutes?
What is that?
My trading warrior brother. Are you in?
Sounds good.
All right. So Gary, you want to show your letter? All right, here, I'll do it. Let me do it because
Yeah, just
that's where you're going to get most of Gary's stuff.
you can get the free stuff at the blog.smartmoneytracker premium. I put free videos up there from
There it
time.
is.
Yeah.
Okay.
And then the premium site, I think that's what you've got up there right now. The premium site is where you can get the daily and weekly reports that I send out to subscribers. I also put some free stuff on Twitter from time to time. My Twitter tag is Gary Savage 1, the number 1.
Gary's a rock climber. So I want to ask you, Gary, do you ever bring a device with you when you're climbing to see where the market's at?
No.
I
I'm
was
climbing,
hoping.
I'm concentrating on not falling off.
That's what I tell people, don't drive and trade. I thought that was going to be your answer. Well, great meeting you, Gary, and thanks for the conversation.
Thanks for having me on, Dale.
All right, Gary. Gary Savage, everybody, check him out. Smart money tracker, and a guy who, you could tell has reasons for doing things, not just opinions. Adios, Gary.